So thank you so much to the Fort McMurray Construction Association, Lana. Thank you so much. We've been working on this for quite a bit, and hopefully this is the beginning of trying to get this through. And of course, I want to also acknowledge that we're uh, working in the 38 territory, the traditional playground of the indigenous people around here in this place. So we're very grateful that we have been accommodated to be able to do what we do. So today's webinar, the original plan was to have it as a workshop. Um, so the time allotted for it took that into account. Um, Given what we have now, moving to full online, certain components will not be done, which is the really and working of how these things work. So um, it might be shorter than what was originally planned, except if discussions and questions and answers take us to the time that we had originally allotted. So my name is Joshua Google, and I'm the chief economist and CEO of AFCOT. AFCOT is a consulting company. It's an economic, finance, risk, and tax advisory company. And so it's in our risk and economic function that we do quite a bit of the sustainability, the climate risk, the GHG reporting, and all that we are doing today is within our economics and risk consulting uh, area of practice. So just a bit of housekeeping still. We will have breaks at certain natural break points, uh, and then we'll come back. Then it also has a seminal structure to it. So at any point in time, please stop me to ask questions, and we will continue after addressing the questions, because the questions and discussions are part of the presentation. Today, we'll be looking at the new international financial reporting standards for climate and sustainability reporting, specifically on greenhouse gas reporting and how that will affect the construction industry. Generally, because we're in this region, the impact on the construction industry will come in from how this greenhouse gas new reporting requirement will affect the oil and gas industry and the construction industry by and large being a service provider of the oil and gas industry in this region. That is, we will look at the connection between the two. We will also look at what support are available um, to support the industry, the construction association members and the construction industry to be able to cope, adapt, and be very competitive in the presence of this new reporting requirement coming online. Now, as far as today's as far as how today will go, you will hear a whole number of acronyms. These new regulations or requirements introduced with them quite a whole number of new acronyms. So anytime you want us to review what an acronym means or what it stands for, please let me know, because the full names are so long that it's easier to use the acronyms. As far as the agenda for today, we'll start with an introduction of the new regulations, the background, and the learning objectives for today. And then we would take a deeper look at the new International Financial Reporting Standard, Sustainability Reporting 1, Sustainability Standard 2, Standards 1 and 2, which are general requirement for sustainability reporting, which is IFRS 1, and the climate related financial disclosure, which is IFRS S2. We will look at the implications for businesses and corporations for these IFRS S1 and IFRS S2, which is the standard 1, the general requirement, and standard 2, the climate related requirement. Then the question we will now be dealing with is how these disclosures will affect the construction industry. That's the specific requirement for disclosures related to the construction industry and what it means for the construction industry. We'll now look at the general measurement and tracking framework that is required to support the industry or reporters to be able to report and track these disclosures. There will be a whole lot of time allotted for questions and discussions in order to bring the presentation and what we have looked at to make sense and to mean something to specific participants in this webinar, and how it will affect their specific businesses. This is the workshop component of it, yes. And then we will wrap up after that. Any questions so far?
Hi, Joshua. It's just Jenny Alla from Acton Environment. I'm wondering if we're allowed to put any questions in that little text box there to make it easier.
Yes. Okay.
Thank
you for bringing it up. So any question you can put it in the chat and the question box. Yeah.
No, I was just asking that one question. Thank you so much.
Thank you so much. Thank you. Now, what is this seminar about, and what are the learning objectives? This seminar is intended first to highlight and respond to the following questions as objectives. What is the changing environment for sustainability and climate related and greenhouse gas reporting? How is the environment changing in terms of regulations and requirements for sustainability, climate related and greenhouse gas reporting? The second big question is, how will this new requirement affect the ability of businesses and corporations in the construction industry in the region to, 1, bid for projects, 2, attract investors, 3, qualify for loans and debt financing? And you will agree these are all critical questions to business profitability, viability, and operations, really. We will also look at how the new requirements will affect the value of companies and businesses, especially if businesses are looking to sell off and exit, if business owners are looking to sell, cash out, and exit the business, as a number of businesses prepare to do in this region. Another learning objective for this seminar is to answer the question, or to provide a way of answering the questions. This question: what are the required disclosures specific to the construction industry? That is, what to measure and track, how to report and disclose, how to assess climate-related risk and opportunities, and what options are available for action for the construction industry. We will also look at, for businesses and corporations that will need support, what support is available to help them, to support them with these new requirements in order to comply with them and remain competitive and viable as businesses. So this is how, this is the learning objective for this workshop. So let's have a bit of a dive down on these objectives. First, the background. It's a regulation and reporting. When it comes to greenhouse gas or climate-related issues, did not just start this year or last year. They've been in the making, especially in Alberta. They've been in the making since 2007, when the specific gas emitters regulation was brought into existence. But one thing that has happened is that whatever happens with greenhouse gas reporting requirements in Alberta has either been driven or forced from the federal level or the global agenda, starting with the Kyoto. When it started, the Kyoto Protocol, when it started gathering quite a bit of momentum. So, but the main effective regulation actually came into being in 2020, which is what we call the Alberta Technology Innovation and Emission Reduction Regulation 2020. This was a bit of Alberta's response to make sure that the federal government's regulations are not coming down heavily on Alberta businesses and corporations. So by bringing about this regulation, we in Alberta took control of certain aspects of the reporting requirement and environment that will significantly affect the industry in this province, and not allow the federal government to come in a way that will probably not be comfortable with. So TIR, I will start using the word TIR, which stands for Technology Innovation and Emissions Reduction Regulation 2020, focused on large emitters of 100,000 tons of greenhouse gas and or more annually are the focus of this TIR regulation. So these facilities that emit more than 100,000 tons of greenhouse gas or more are required to comply with emissions intensity limits specific to the industry. And of course, the oil sands industry in this region is big in this. So tier regulation affects the oil sands industry. Now, tier regulation also has within the tier system a way of allocating, quantifying, trading, and of offsetting carbon credits. So it sets up within Alberta the carbon credit market. And emitters can either reduce, that's emitters of 100,000 tons or more can either reduce below the limits and earn carbon credits, or can start carbon offsetting projects to make up for their carbon emission above the limits, or can, through the credit system, purchase carbon credits to offset their limits, or the part of their emission above the limits, or they can pay the fine or the payment required to be able to emit above the limit they are allowed to emit. So the government also within the third system has the carbon competitive incentive program, again, which allows industry emitters that are able to reduce their carbon footprint to earn credit and use that credit as part of their value proposition to investors, to the market, and also use it as part of their value, that's their reserve value. We also have in this province the methane emission reduction regulation. Methane, because methane has been recognized as one of the key elements of the greenhouse gas component. Now, methane also, because again, we have the cattle industry that we also want to make sure that we are in control of what happens to it, rather than wait for outside regulations, either from the federal government or from international treaties and all that, to come and take control off of us. So Alberta's strategy is to make sure that critical industries in the province are protected or encouraged or regulated first by internal regulations before exposing them to external regulations or external processes. And then in 2019, the reporting and verification of greenhouse gas emission regulation came into being. This requires third-party verification and audit process to be used to support entities and facilities reporting or emitting more than 100,000 tons, so that there is a third-party verification mechanism to verify what is reported by emitters. So the third-party verification requirement, you can look at it as an audit, independent way of verifying what is reported. And this also became a requirement for emitters that emit more than 100,000 tons of greenhouse gas annually. Of course, all these have a backstop component to federal government regulations for facilities that do not meet equivalency agreements and, and are specified under the tier regulation. So generally, this is the initial background, the background up till last year when the International Financial Reporting Standards came in. Now, another thing you will notice is that much of the regulations until now were limited to large emitters. And so small businesses or service providers were mostly excluded or were not cut off in this regulatory environment. This is one key reason that we dealing with small businesses, or we in the regions that are mostly small and medium businesses have not felt the impact of regulation, although regulations have been in the making or have been effective for long or longer than we've been aware of. However, something changed from last year. Last year, the international ISBB, which stands for International Sustainability Standard Board, was formed 2 years ago. And the driving force for this was that the international emission reporting requirements, emission reporting standards, greenhouse gas reporting frameworks were so diverse, were so non-uniform. It was becoming as if the entire world or the entire regulatory reporting or greenhouse gas climate reporting, however you want to say it, the entire world of it was fragmented. And it caused quite a bit of confusion when companies, businesses were stating their emissions or reporting their emissions. The confusion was that what was the standard? How do we compare between two businesses, between two corporations? This was big for the investment community. This was big for the financiers, those who provide resources for businesses, because ESG, that's environmental, social, and governance issues, started playing critical role in investment fund allocation, in the way that investors were measuring the sustainability or climate impact of their investment. So having a uniform way of looking at these emissions or the reports coming through from businesses or the targets or the standards, having a uniform way of looking at them became critical to measuring or to having a uniform way of measuring ESG components of investment, of finance. Hence, the International Financial Reporting Standard, that's the IFRS Foundation, was now called upon. Now, if you want to know what the International Financial Reporting Standard, that's IFRS Foundation, is about, this is the same body that standardizes or regulates globally financial statement, financial reporting. So when you take, for instance, your business's financial statements, how it is reported, what is presented is standard. And this standard is understood across the world. So without regard to where your financial statement, for instance, for your business is looked at, where it is submitted, anyone looking at it has a common frame of what to expect. That is income statement, what an income statement should be, cash flow statement, what it should have, how it should be, or your balance sheet. So it is this same international financial reporting standards through the accounting standard board that regulates, or how do you put it, regulates how a financial statement should be. And the consumers of financial statements are primarily providers of financial resources to businesses, either banks or shareholders or investors, or they are regulators like tax authorities. So this same body, being used to setting global standards for businesses and corporations, was now called upon to set standards, to standardize the reporting of sustainability and climate disclosures, the reporting of climate impact of investment, climate impact of businesses, or climate risk and opportunities of businesses. Now, from this point, I will start using the term risk and opportunities. Why? Because when the International Sustainability Standard Board was set up within the International Financial Reporting Standards Foundation, IFRS Foundation, the focus shifted from just climate impact to climate risk and opportunities. Why is this important? Because investors want to be aware of the risk of their investment, of the risk of the businesses they're investing in, of the risk their finances are exposed to on the one hand, but they also want to make sure that they are properly allocating financial resources to exploit the benefit of this risk in the opportunities provided by climate related activities, or activities that will have impact on the climate or sustainability. So it became a matter of risk and opportunities. So where are the risks? What risks are businesses or corporations exposed to, and what are the opportunities available to businesses and corporations in the climate and sustainability environment, in the climate and sustainability sphere? The second critical element that came out of it, of this new set of regulations, and this is where it became impactful to service providers like small businesses and corporations, small and medium businesses, is the inclusion of what we call scope 3. And I will go to the various scopes of this. This is just an introductory slide. The inclusion of scope 3 in the reporting. Scope 3 is focused, or is related to the supply chain of big businesses, the supply chain of industry. This is where service providers are involved, whether on the upstream side or on the downstream side of any business. or of industry, you have the scope 3 players. And this inclusion of scope 3 is what brought in the small and medium businesses to focus in the global and national and provincial regulatory environment. Now, it also focuses on third-party providers of resources to businesses and users of reports. That is, investors, banks, and shareholders, and other stakeholders of businesses and corporations. The IFRS came out with two broad disclosure standards. Standard 1, which is related to general sustainability financial disclosures, and Standard 2, that focuses squarely on climate-related financial disclosures. Yeah, yes, let's take a 5 minutes break at this point. Is that okay?
That's great, thank you.
Yeah, instead of 15 minutes, we just take 5 minutes break. So we can return at 8. Yeah, we can round it up. We can return at 8:10. So during this time, if you have questions related, I can take them, or we can just take a break. Now, to the answer, I think yes, this recording will be available, but this is subject to what Lana is thinking. She is in charge of this. Jenny.
Hey, Joshua, my name is Farai Chungwena from Coverall in Tiger Nova Crescent. Can you hear me?
Yes, I can hear you very well.
Great stuff. I'm very interested to see, because, you know, most of the reporting here is based on IFRS, and most of our organizations actually don't do financial reporting based on IFRS. We do reporting based on accounting standards for private enterprises. And I am keen to know if there is any move to develop a similar framework for GAG reporting or ESG reporting based purely on ASPE, or the beginning is just to develop a framework based on IFRS and then later on cascade it down to SPE, because we are purely focused on ASP, most private enterprises.
Yes, so what usually will happen is, remember, the impact of this IFRS on the small businesses is that the big, like the Sunkers of this world, for instance, right?
Yeah.
Within their reporting, they are required to, within their IFRS, the standard reporting, they are required to report their scope 3 footprint, their scope 3 impact. Which that scope 3 is what we now come down to the small businesses, because the scope 3, for instance, of Suncor is all the service providers.
Yeah.
So when Suncor wants to report its scope 3, it will come to the service providers to require them to report to them.
Right.
And so how Suncor will require that reporting, whether through the financial statement, because they are required to report through their financial statements, right? Or an explicit part of the way now they do the safety reporting, right? So they could require that all their vendors, right, submit a report, or they can provide a mechanism for their vendors to report their emissions.
Right.
Right. in a way that they can now include them the way they currently do with safety reporting.
Yeah. Yeah, that
Now,
makes
this
sense.
is one way they can go. I don't know exactly how they can go, but I suspect that they will do it the way they have always done it when they are required to report on their service providers. And a good example would be their safety record includes the safety record of their service providers, right?
Correct. Yeah.
So they have found a way to force them to report either as a requirement for registration or as a requirement for bidding or in one or other ways. So this is how service providers should expect it primarily. But when it comes to direct regulatory reporting, it is still further, that's for service provider, it is probably still further down the road because Alberta still looks at those who emit above 100,000 tons,
Right.
primarily. So, and the other way that small businesses will be impacted is, for instance, banks, as you will see, as we go through it, banks are required to report on the emission because this scope 3 also affects banks. The scope 3 of the loans they are giving. Insurance companies are also required to report scope 3. So which means that insurance companies, banks will find a way to ask service providers like you to report.
Right. Very well explained. I appreciate the response.
Yeah, thank you. Okay, so I'm assuming we're all back. Can you hear me? Hello? Hello?
I am available.
Oh, okay.
Yeah.
So
Yeah.
you can,
How many people? How many people are in attendance? I thought I could see from my
Oh,
screen.
can you
but
hear me, Joshua?
Yes, I can hear everyone. I can hear everyone.
Oh,
Yeah.
I don't know if I'm on.
Yeah,
Joshua,
so
there's 3 on. There's 3
Did you put
attendees.
yourself on mute by any chance? Or is it on my end?
Can everyone hear me?
I can hear you, Joshua.
Okay, Jenny, it's probably on your hand, I guess. Jenny, can you hear me? She can't hear me.
So how many people are in attendance, Joshua? I'm just keen to know.
I can see 5 people.
Okay.
I
Fair
can
enough.
see 5. Yeah. So, Jenny, I think you should probably check your. I think everyone else is hearing me. I mean, she cannot hear me, I guess.
Yeah, she might be on mute or something.
Okay, so let's continue. In the next part of this webinar, we will look at what the greenhouse gas protocol is all about briefly. And then we'll take a deeper dive in the scope 3, not deeply, but because this is the area that impacts the industry and service providers. We'll look at what it means, how they came in through the scope 3. And we'll take a look at the Sustainability Accounting Standard Board's standards for the construction industry briefly. And then, yeah, this is what we're going to do this part of the webinar. So what is the greenhouse gas protocol, the GHG protocol? Basically, further down some point in history, the World Resource Institute, there are a whole lot of acronyms, and the World Business Council for Sustainable Development came together to start pushing and lobbying for focus on climate-related issues in business. They came up with a whole lot of standards and tools that are designed for specific purposes within the context of greenhouse gas accounting and reporting. This was a global attempt at the global level. But the 2 main standards for our purpose that came out of the greenhouse gas protocol were, 1, the corporate standard, which were designed for businesses and other organizations to measure and report their greenhouse gas emissions. It provides a comprehensive framework for accounting and reporting emissions from direct operations, which is what we call scope 1. So for scope 1, for instance, of the oil sands industry, you will be looking at the emission directly related to the operation of bringing out, that's mining the oil sands, processing them, the thermal plants or the heating plants, all the things they do at site or in their offices by the emitter. In this case, say Suncor. When Suncor's operations directly, what they emit, whether in mining the oil sands or in processing them, these are what we call scope 1. Then it also provides a framework for accounting and reporting emissions from scope 2, what we call scope 2, which is purchased energy. So energy that is not generated by Suncor, whose primary aim is to mine and process oil sands. The energy it purchases, either from the grid or from third-party providers, that it consumes in doing so, in carrying out their operation, this is scope 2. The emissions related to purchased energy is what is termed scope 2. Now, scope 3 in the greenhouse gas protocol is what is involved in the value chain and supply chain activities, whether it's supply chain from, say, a trucking company providing trucking services to Suncor. It's not part of Suncor, but it's in the value chain of Suncor. So that is scope 3. Construction company building site battery for Suncor, it's part of the scope 3. Waste management company providing waste management services to Suncor is part of the value chain and supply chain, therefore scope 3. Pipeline companies, all these service providers, whether in the upstream sector, in the upstream of Suncor, that is providing input services, or on the downstream side of it, are all in scope 3. Yes, Jenny, there are causes that focus on reporting requirements. We will look at some of them here, but for certification purposes, what I will suggest is the Alberta government provides reporting under the third, that's causes that are related to reporting under the third regulation. So whether for reporters, verifiers, and how to quantify methods and all that. I don't know if I can't see you on my, let me see, on my screen to unmute you, Jenny. Lana, is there a way of
There
doing
we go.
that? Okay.
I think someone muted me, but sorry, I just have one quick question.
Okay.
So in relation to like scope 1, 2, and 3, so you say direct operations. Like I get that when you say like the heating, like you
You're
in
muted.
SAG-D project. I know, someone just muted me again.
Yeah.
Okay, so when you're talking about direct operations, would that be like, let's just use Suncor as an example, if they are actually hired by Suncor to be direct, or would it be like a supply? So what if, like, let's just say, so okay, that answers my question. So then if a welder, let's just say, works directly for Suncor, wouldn't it be a supply chain unless it's a contractor, correct?
If it's a contractor, it's a supply chain. But if it's employed by Suncor, it's direct operation.
Okay, perfect, awesome, thank you.
Yeah. So scope 3 standard, now talking about the scope 3 standard, it focuses specifically on accounting for and reporting indirect emissions in the value chain or supply chain, and provides guidance that's under the GHG protocol for scope 3. The GHG protocol provides guidance on assessing emissions associated with the entire life cycle of a product or service, including the upstream part of it and the downstream part of it. So whether the scope 3 emitter is on the upstream or on the downstream side is covered under the scope 3 standard of the GHG protocol. Now, what are the greenhouse gas emissions that are covered, or what gases are regarded as greenhouse gases under the protocol and for reporting purposes? You have carbon dioxide, you have the CH4, that's methane, the nitrogen oxide, the hyperfluorides, and that's HFCs or the PFCs, or the sulfur fluorides or the nitrogen fluoride. So, and so as far as the reporting goes, this scheme is straight out of the greenhouse gas protocol handbook. So to see how it works, scope 1, which is direct, includes even company vehicles, like Jenny was saying, the company welders emissions, as long as it's employed directly by the company and by the facility, they are all under the direct scope 1. Scope 2 is purchased goods, primarily purchased energy. For instance, purchase electricity, steam heating, and cooling for own use. Right? Scope 3, which is where we are concerned about, that will affect small and medium businesses in the region, in the industry, that are providing services to the industry. It's all in scope 3, which are indirect, and that will be whether it's leased real estate, or employees using their vehicles, or like you will see the transportation providers, business travels, waste generated in operations, transportation and distribution, fuel and energy related activities, or capital goods, or purchased goods and services provided along the supply chain on the upstream side, which is going into the production, or on the downstream side, which is going outside, post-production, to the supply and consumption of the goods and services produced. And there also we have transportation, processing of sold products, waste management, end-of-life treatment of products, you name it. As long as these are indirectly related to the industry. Now, for us in this region, because most of the economy of this region, if not substantially so, is tied to the industry, isn't it? Therefore, it almost feels like everyone in this region is on the scope 3 of the industry, or almost every business. Does it make it clear what we are talking about? So, for the 7 core greenhouse gases covered under the Kyoto Protocol that have been the subject of reporting or regulation: carbon dioxide, methane, nitrous oxide, hydrofluorocarbons, perfluorocarbons, sulfur hexafluorides, or nitrogen trifluoride. So what are the key features of the greenhouse gas GHG protocol and the principles? 1, completeness. Businesses are expected to account for all significant emission sources from scope 1 to scope 3. Now, significant, the word significant has always been the subject of debate. What is significant? And we will come to look at it. Relevance. The second feature embedded in the principle is what is relevant. Emissions that are relevant to their operations and have a material impact on their overall carbon footprint. Now, if you combine the word incompleteness, significant, and you combine that word significant with the word material in relevance, you will find that you will begin to see why, although these things have been around for long, the disagreement, the divergence, the fragmentation of what these two words mean and how these have impacted reporting and regulations. What is significant? What is material? That is a core thing. And this is what has been resolved in the current standard, in the current reporting standards. The third feature and principle is that there has to be consistency, a standardized methodology and emission factors to ensure consistency and comparability of emission data. Jenny, coming back to the question of whether there are trainings, this part of it, methodology and factors, they are more or less regulated. For instance, in Alberta, we have the Alberta methodologies and Alberta emission factors that we apply in the tier regulation. And in the IFRS, the recommendation is that you use the methodology and the factors in given jurisdiction, because different countries, regions within different countries were never able to agree on methodologies and emissions. In the same way that, to the question about financial reporting, different countries have local GAAP, right? That's accounting principles. Although there are global principles, but when it comes to different countries and jurisdictions, they have specific ways of looking at these things or what material means. Right? And this is what is also obtainable with this greenhouse gas protocol, that countries and regions within countries have specific methodologies and emission factors, both for the region and for specific industries within the economy. And so in Alberta, we have it. And so in Canada also we have it. But there is there is also a general framework for these methodologies and emission factors on how to develop them or what is critical globally. And they are also expressed in the IFRS S1 and IFRS S2, that is the sustainability and climate related disclosures standards. The fourth principle and feature is that there has to be transparency in disclosure. That's relevant information about companies must be transparent in their disclosures, especially their methodology, the data sources and assumptions made in order to allow for credibility in reporting. Then there is an issue of accuracy. And there are guidelines and best practices for continuous improvement and accuracy of emissions calculations using the methodology and the factors, applying them to the data, whether the accuracy of how data should be collected, how the emission factors are calculated, and the quality control measures that go into the measurement, the calculations, and the reporting. So these are the core features and principles of the greenhouse gas protocol. That is the completeness of the emission sources, the accounting for all the emission sources, the relevance and materiality, how this impacts the operations and the carbon footprint, the consistency over time and in time, and the transparency of sources, credibility, assumptions, and methodology, and of course, the quality control in arriving at these figures, these measures, and the accuracy. Now, from this point, you can see how small businesses, in trying to comply with conditions, for instance, given by their customers, their clients, or conditions given by the clients, will impact how small businesses operate, and how some of these could easily overwhelm small businesses. Because let's face it, small businesses are focused on doing what they do best, in supporting industry, in supporting companies. But some of these can easily have their own lives and take over substantial effort and resources for small businesses. If you want to look at it, try to imagine how it will be for small businesses to prepare their own financial statements and deal with auditors and all that. Most of the time, small businesses use bookkeepers and accountants external to the business, or they employ these professionals within the business to deal with these issues, because they could be very overwhelming and distracting. And if this reporting is required by banks, by clients, then a way of dealing with them is always a great strategy for small businesses or suppliers or medium-sized businesses that are in the supply chain or value chain of big businesses. So what are the standards and features of the Sustainability Accounting Standard Board? Now, the Sustainability Accounting Standard Board sets the standards that are implemented within the IFRS S1 and IFRS S2 framework or standards. They are the ones setting the standards. Now, the goal of the standards set by the Sustainability Accounting Standard Board, and we will look at it as a SASB. Let's continue to call it a SASB. SASB was set up with the goal of, now, SASB was set up before the International Financial Reporting Standard Sustainability Standards were set up, or the International Sustainability Standard Board was set up. Before the International Sustainability Standard Board was set up, SASB was set up with the goal to advance the disclosure of financially material and decision useful sustainability information to investors. Now, you can see how the industry begins to move away from just general reporting, compliance, and regulation that are focused on the greenhouse gas, from the greenhouse gas protocol, towards this movement towards what is financially material, what is useful, what is important for investors. To see the difference, let's go back to the features of the greenhouse gas protocol and the principles. It's about completeness, it's about relevance, it's about consistency, it's about transparency, it's about accuracy. But the greenhouse gas protocol did not say anything about profitability, competitiveness, whether this is good, how much will it cost businesses to do this? What is the impact of this on the bottom line of businesses and corporations? What are the financial implications? Yes, what is material and what is significant can be discussed, can be debated upon, but what is financially material, which is important to investors, is not captured in the greenhouse gas protocol. So the first attempt to do that is within the Sustainability Accounting Standard Board standards, where the focus is now on financially material and decision useful. You get the difference, the shift in focus. So some of the features that came into play that were now specializations or layered on the greenhouse gas protocol principles and features is that it's got to be, the standards became industry specific, because different industries experience different levels when it comes to talking about financially material and decision useful information. What is useful, what is financially material and decision useful for the oil sand industry might not be the same as what is financially useful to, say, the semiconductor industry when it comes to the greenhouse gas emissions. What is significant, what is material might be different from industry to industry. What is significant and material, financially material for the construction industry will be different from what is significant and materially useful to, say, the consulting industry. So SASB begins to make the standards industry specific, tailored to the unique sustainability, risk, and opportunities material to investors, and the specific environmental, social, and governance factors relevant to each industry. What materiality focus became an emphasis on most relevant and impactful for investors. Remember, I mentioned that the issue of materiality and significance were debated, but the Accounting Standard Board makes it specific to investors. What is impactful for investors? And then there's an integration, a movement to integrate and link sustainability metrics with financial metrics in order to have a more comprehensive understanding of a company's financial performance. So this is the beginning of the movement towards integrating the sustainability and climate-related reporting within the financial statement and valuing a company not just on the financial performance of its operation, but also the impact of the risk and opportunities it is exposed to when it comes to sustainability or climate issues. Integration makes it open for investors to now begin to have a say on what companies do or do not do if they are to provide resources, financial resources. This integration also opens the door for banks, insurance companies to begin to have a way of seeing through, and they have a say in what companies do or what corporations or businesses do not do when they are to invest or provide financial resources for businesses. The SASB standards also feature stakeholder engagement, inputs from a diverse range of stakeholders, including the companies, investors, regulators, and advocacy groups within the environment where the industry or the corporation or the business plays. But one critical feature is that it's primarily used by investors. It is to assist investors in making more informed investment decisions by providing standardized, comparable, and decision useful information across different businesses, different industries, or businesses within an industry or industries across different economies to be able to make decisions on the basis of standardized information. So, what are the key topics of the Sustainability Accounting Standard Board relating to the oil industry and the construction industry? The focus of reporting, of measurement, of accountability, what is considered significant, and from where materiality evolves for the construction industry and the oil industry. These are the key areas relevant to the construction industry and the oil and gas industry that the region is exposed to. One, construction and land development, impact on ecosystem and biodiversity. So let's say real estate development, if you're going into a new area to develop from green development, banks, investors will begin to require information on the impact on the ecosystem, on land use, on land development practices, information on land use and land development practices. This is on construction and land development. On operational impact, it focuses on energy use and efficiency, emission during operations of construction. That's whether it's road construction, real estate construction, site construction, the operational aspect of the construction work. That is energy use in vehicles, in equipment, for power, the emissions, water use and water management. All these are relevant to the construction industry. Resource efficiency and on the circular economy is relevant to the construction industry. That is the waste management practices, sustainability sourcing of materials, the community impact of the construction activity. That is community health and safety, community engagement, or the human capital development aspect of the construction of the operation, which is the workforce health and safety and the workforce engagement and development. And the business model of the business of the corporation, the innovation in construction and infrastructure development, the resilience to climate and environmental risk of the construction, whether infrastructure or the business. So these are the topics that are covered in the construction, specific to the construction industry. So reporting must cover these elements for the construction industry. Now, for the oil and gas industry, the environmental management component of it must be covered in reporting. It's a carbon footprint or greenhouse gas emission in accounting for them. Water management, biodiversity, the social capital aspect of it, health and safety, community impact, social licenses and permitting, that is community relations and community advocacy group, the human capital part of it, the workforce engagement and development, land practices, the business model, resource efficiency, innovation in exploration and production, how that progressively decreases the footprint, then the management of climate risk, assessment and management of climate-related risk and opportunities that will impact the business, that will impact the value of the company, that will impact the performance of the company. So these two areas, one for the construction industry and one for the oil and gas industry generally, are the areas of reporting specific to these industries. And their sustainability reporting compliance must cover these areas. Now, if you look at the oil and gas industry, for instance, their water management, their land use, their labor practices, their health and safety practices, their resource efficiency practices, you can see that they are all tied to service providers, isn't it? Because by and large, for instance, our experience here in the region for the oil sands industry is that most of these components are contracted out. Now, before the effectiveness of the new requirements, reporting requirements, because they were contracted out, except in health and safety that were heavily regulated provincially, they were not reporting on the impact of their suppliers along the value chain until now. Now, with the inclusion of scope 3, they will come heavily on their service providers in these areas. So each of these areas, environmental management, social capital management, human capital, business model and innovation, management of climate risk, each of these areas that affects or that is implemented by service providers can expect that the industry will come to them for reporting in these areas. Exactly the same way that they require service providers to report on health and safety issues, to report on social licenses and permitting issues, or community impact issues. Now they will come for emissions, greenhouse gas emission issues. They will come for water management issues. They will come for biodiversity and land use issues of their service providers and require them to report. This is the key impact on service providers. So, should we continue or take a 5 minutes break? Or any question at this point? Okay. Hello. Could you please? I think someone is trying to. Is it Jenny that is trying to say something? Okay. So, if no question, let's have another. This time, let's have 12 minutes break. I think we're ahead of time, so we can be. So 11 minutes break. So if we return at 9 a.m., is that okay? So coffee break 9 a.m. Is that okay? I can't hear anybody. Can you hear me?
Yep,
Okay.
I can hear you. That's fine.
Okay. Okay. We come back.
I can hear you as well.
Yeah. 9 a.m. Let's have a coffee break. Yeah.
Yeah, sounds good. Thanks.
Thanks.
Okay, so I guess there's 30 seconds more. Okay, so then we're all back, I guess. So this segment, we will be looking now on the new, specifically the new requirement, what to report, how to measure and track, and how to report the required reporting topics so basically we look at the reporting topics for the construction industry and the reporting topics for generally for the oil and gas industry, and how the reporting topics for the oil and gas industry will come to be a requirement on the service providers, to the extent that the oil industry contracts out services that are covered or generate issues along these topics. As a general introduction on the IFRS sustainability standards, the International Sustainability Standard Board, the IFSB, is part of the IFRS Foundation, set up to drive sustainability reporting, climate-related reporting, standardize it, make it universal, and it was driven primarily by the investor and business community's need to unify standards across the world, across the investment universe. It is driven by the need for universal comparability. It's focused on risk and opportunities, not just on feel good things, but on the risk and opportunities. So in the same way that a service provider could see an opportunity to reduce energy consumption or energy carbon footprint of energy or renewables, or to implement offsetting projects. This is on the opportunity side. There are also the risk that if it's not done, could regulations come and hinder the operations of the business? Will the business lose its social license, community license, its stakeholder capital, that is social capital? So these are the risks. On the opportunity side, okay, given that the businesses face this type of risk, what opportunities are out there for service providers to take advantage of? For instance, reclamations, offset projects, carbon reducing initiatives and projects, those type of things. That's why it's a focus on risk and opportunities, because investors want to balance their risk with their return, but they also want to invest in opportunities to make more money, right? So the IFRS, therefore, reporting is a focus primarily on risk and opportunities, not just on the risk, but also on the opportunities that climate activities, climate impacting activities, or carbon footprint activities can bring about, and to be able to provide resources and financing to exploit and develop those opportunities. So it's not why talking about opportunities is important is that, say, generally, whenever people talk about climate and carbon footprint, there is the general tendency to move towards a way of thinking about it as clamping down on businesses or um, reducing competitiveness, viability of businesses. But this IFRS thing makes a way to shift the focus, this sustainability standard requirement. They make a way to shift the focus, or also to look at the opportunities to make more money, to make new money, to move, to open up new opportunities for both business and economic growth, right? The entire business model of Tesla, for instance, is on opportunities provided by climate-related issues. So thinking about it holistically in the risk and opportunities framework allows businesses to not just look at what to do less of, but also what to do more of in order to make more money. Hence, the focus on risk and opportunities. The reporting standards which were released, so 2 reporting standards were released June 30th or July 1st, depending on how you look at it, what part of the globe you are when it was released. There are 2 standards that were released this year. The plan is to make them effective January 1st, 2024. But because businesses reporting more than or emitting more than 100,000 tons are already reporting in one way, for instance, in Alberta, under the TIER, the Technology Innovation and Emission Reduction Regulation. Anyway, it's a complement. It augments and it consolidates what they are already doing. However, the new part is that these requirements will now flow down their scope 3, and there is a transition period. There's a transition period, but the key is that they are designed to be effective January 1st, 2024, which is less than 2 months away. So what are these new regulations? New standards, not regulation, new standards, required reporting standards. First is the general requirements for disclosure of sustainability related financial information. This is the broad ESG area. The general requirement for disclosure of sustainability related financial information, which is termed IFRS S1. The second one is the IFRS climate related financial disclosures, which is squarely focused on the greenhouse gas emissions and the reporting needed to comply with those requirements of the disclosure. This is what is termed IFRS S2. Now, while IFRS S1 is about general sustainability issues like ESG, the ESG issues, which are social, which are governance, which are environmental, that the risk and opportunities the business is exposed to, in this case, including the risk and opportunities, the scope 3 of the business. The suppliers along the value chain and supply chain are exposed to the risk and opportunities that are material to a business that can impact the financial performance. That's why they are financial related. That can impact the financial performance of a business. For instance, Suncor, again, is required to report on the risk and opportunities. Generally, the sustainability related financial risk and opportunities that their suppliers are exposed to, that are considered material to Suncor's business and financial performance. So this is how it goes. And so for the climate-related financial disclosures, it's the same thing. The risk and opportunities, not just the direct ones, but the suppliers and service providers of Suncor are exposed to, that are material, that will impact Suncor's financial performance. Suncor must report on them. So these are the two standards. Now, therefore, all industries, according to the financial reporting disclosure requirement, the IFRS sustainability disclosure requirements, all industries are required to report on sustainability related risk and opportunities material to operations, and climate related risk and opportunities material to the operation. And they are to report on their scope 1, scope 2, and scope 3 risk and opportunities. Now, what are these risk and opportunities? The risk and opportunities are divided into two broad areas. One, physical risk and transitional risk. Now, what are physical risk? Of course, take for instance the construction industry. Let's say a road building company, right? Physically, it is exposed to labor, it is exposed to its material it uses, it is exposed to the sustainability of its operations in the immediate, whether it's community related, business related, human capital related, emissions related, that's on the general sustainability reporting side of it. On this waste management, it could be stopped, it could be, things can happen to it. Now, the transitional risk could be also regulatory. For instance, transitional risk could involve, say, Canada, as we've committed to 2050 limits. And Alberta, through the tier regulation, we continue to move towards lower and lower emission limits. And they provide transition mechanisms. For instance, a business could be using, take for instance, a construction business could be using construction vehicle, construction equipment that could be caught up in regulation that might be outlawed, might cease to exist, for instance, because of its impact on climate. So the risk is that at some point, this equipment will not be available. It could be a bulldozer that is emitting at a limit, at a rate or at a level higher than it's required. It could be the collective, the total emission, carbon footprint, let's say greenhouse gas, of the equipment of the vehicles that, say, a client like Suncor will consider too much emission. And so what if Suncor outlaws or stops or limits the use of such equipment on their sites in their contract at certain point? See, this is a transition risk. What will happen to the business, the service provider? Will the service provider be able to take on that kind of risk and survive? How will it impact the business? Now, as the service provider or the business begins to transit, what risk does it take? It will start with new technology that it is not used to. It will probably take on training human capital to be able to use innovative new technology. Will this work? What is the cost of doing that? How will it be successful in doing that? All those are related to transition risk. There could be also social risk, transition risk. For instance, in our region or in Canada, we have quite a bit of transition risk or social risk that we've been managing, especially in the context of indigenous reconciliation. Right? There are certain businesses increasingly that are beginning to feel the impact of that movement towards a more accommodating, self-reinforcing, mutually beneficial business and operational environment for all Canadians, for all communities and businesses in Canada. So some of these are considered social risk on the sustainability side. They are also considered physical and they are also considered transitional risk, because we are transiting from one known to something that has not been tried, and businesses must make certain adjustments. And whether those adjustments will be too costly or they will be successful or not is not known. So there are risks. New regulations are coming in to regulate aspects of business operations, starting with the big companies, the major emitters, the major producers like the Suncors, but Suncor requiring their service providers along their supply chain to be able to comply to those regulations, to comply with those new regulations in order to continue to work with them so that they can maintain their social license to operate, their physical license to operate, their performance, and also continue to attract investors. So these are the physical and transitional risk, but they also provide opportunities. For instance, a company operating within the region, a construction company, can look at the space and say, let us innovate along lower emitting tools and equipment, or let us move to invest machines that can lower the emission or that can lower footprint, or let us, on the social side now, let us develop a business model that will be so successful we can use that to attract better workers. We can use that to attract bigger businesses. We can use that to attract better relation with communities, with all other stakeholders, and also employees, and maybe even sell those technologies those know-hows, those models to other businesses. This is the opportunity side of it. Now, these risks and opportunities must be, or for them to be relevant, they must be material to the financial performance of the business. And of course, the regulatory, social, and environmental risks play into those risks, are also part of those risks and opportunities. Now, what is the framework for reporting? So when we are reporting, when a business is reporting along those topics we've looked at for the construction industry, and we will come to the measurement part of it. The framework for reporting is on governance, strategy, risk management, metrics, and targets. Now, what does it mean by governance? Governance is how the business allocates responsibilities. So it answers the question in the organization, in the business, who is responsible for what in dealing with climate and sustainability related risks and opportunities? Who is in charge of what risk? Who is in charge of opportunities? How do we do that? This is this responsibility and reporting framework is what we call the governance. That is who is in charge of what in the organization, from the CEO or from the board chair to all the employees. Who is responsible for what aspect of the risk and opportunities? Businesses are required to report on that as one of the critical framework of reporting, in the framework for reporting. The second is the strategy. What is the strategy? How do we manage it? What do we do to manage to the risk and opportunities? What is being done? What is the process? What is being put forward? The technology, the infrastructure within the organization, the approach the organization is taking to manage the risk and opportunities is expected to be reported, is required to be reported. The third aspect of the reporting is the risk management. This is the process used to identify, prioritize, and monitor the sustainability and climate-related risk and opportunities their business is exposed to. So how do we identify the risks and opportunities? How do we prioritize these risks and opportunities in the way that it impacts the organization? What is important? What is urgent? What are we dealing with now? What are we dealing with more? This risk prioritization process. And how do we allocate resources and monitor the effectiveness of our approach and the resources in managing, in dealing with the risk and opportunities the business is exposed to? Along the topics that I have described, we have seen for the construction industry, those topics: land development and waste management, wastewater consumption, and all that. So each of it, what is the risk? Who is in charge of it? What's the approach to dealing with it? How do we identify the risk? How do we prioritize them? What we do when we do it, what we manage, what we avoid, what we insure against, and how do we monitor the progress we're making? Then The fourth part of the framework is the metrics and targets. That is, how do we measure? And this is particularly important for the emission part, right? How do we measure our footprint? How do we measure the impact? Whether in how we travel, the vehicles we use, the construction equipment we use, our social impact. How do we measure? What are the metrics? What do we measure? How do we measure them? And this has to do with the technology we use, the data we use, how we generate the data, and we will look at that in a short moment in details. And the targets we set. What targets do we set? Remember, it's about comparability. Comparability means how you compare to yourself relative to preceding reports, what targets you set for yourself, and the movement towards those targets year on year. What is the frequency of reporting? And in these reports, what are the targets and what is the movement towards the target? Because there is a strong support for targets set within the company, within the businesses, so that the businesses itself is first internally able to assess whether it is making progress towards those targets it has set for itself. But those targets are also sometimes set by regulation. For instance, in Alberta, for under the tier system, businesses, as we've seen, have limits, targets set by the regulation. Businesses also have internal targets they've set for themselves. Now, how does this impact? How will this impact construction industry, that is service provider, for instance, to the oil and gas industry? In the same way that currently the service providers experience the targets and reporting for health and safety issues, the industry will begin to set targets for its service providers on the basis of the baseline of the service providers along the supply chain, along the value chain. And so this is how certain targets could come to the service providers. For instance, in health and safety, which is part of sustainability reporting, right? The industry has set zero mortality rate because it has set for itself zero mortality rate. So that zero mortality rate flows to all its service providers, that they must have zero mortality while doing their work for them and generally. So this is a target that came in from clients, from the industry onto service providers. But it's also good for service providers. So when it comes to sustainability reporting on safety, on health and safety, we already are experiencing it. But now it will also come regarding emission targets. And some of these emission targets will be set by industry, some of it will be set by businesses. And businesses can also set opportunity targets, how to exploit opportunities provided within the industry or within the economy along those lines of climate-related and sustainability-related financial disclosures. Any question so far? So for the X1, that is the general requirement. The objective of the general requirement for disclosure of sustainability-related financial information, the key objective is to require businesses, an entity, to disclose information about its sustainability-related risk and opportunities that is useful to primary users of general purpose financial reports in making decisions relating to providing resources to the entity. Now, let's open up this a bit. Who are the users of general purpose financial report for any business? Of course, the users are one, those who provide financial resources, whether it's loan or equity finance, debt or equity finance, whether they're investors or they are banks, or they are regulators like the tax authorities. With all those who consume financial statements, all those that are targeted by businesses' financial statements are also consumers of these sustainability related information disclosures. So if currently a business, in order to have financing, let's say from the Business Development Bank of Canada or commercial banks, if currently they are required to submit financial statements, going forward, those financial statements must also include sustainability disclosures relating to financial information. So sustainability related financial information must be part of these financial statements in order for them to be regarded as complete, accurate, and relevant, whether they are banks or they are investors, because these are the primary users of financial statement, of financial reports. Again, as we've looked at it, the core content of the report is one, the governance. That is the processes, the controls and procedures used to monitor and manage the risk and opportunities in an organization. The approach used to manage the risk and opportunities, as we mentioned. The processes, the risk management process, that is the processes used to identify and prioritize and monitor the risk and opportunities, and the metrics and targets, that is the performance in relation to the risk and opportunities, including progress towards any target set or required by law or regulation. As we mentioned, the targets could be set by the business in order to exploit certain opportunities or do or avoid certain things, or they could be set under law or by regulation. Now, the general reporting requirements are to be guided, as we saw, by the SASB specific industry, the specific industry guidelines. For instance, if we go to, we saw this with the, when we talk about the SASB industry guideline, we're talking about this. The construction industry is to be guided by these topics while reporting. The oil and gas industry is to be guided by these SASB topics while reporting. So this is what we mean when we say the source of guidance is this SASB specific to the industry. So the timing and location of report is in the financial statement. So where is the report going to be located? Generally for industry, industry is required to make this report within their financial statement. So it's going to be the same way that if you take a financial statement, you're going to see income statement, you're going to see cash flow statement, you're going to see balance sheet, that financial statement of financial position. Now, from January 2024, for industry, you will also see sustainability related financial information. And you will see it as a separate statement within the financial statement and in what we call management discussions and analysis part of it, where it drills down into these disclosures along this core content: governance, strategy, risk management, and the metrics and targets. The timing coincides with the timing and frequency of the financial statement. So, however, the financial statement, the regularity, the frequency of the financial statement, because these reports are included in the financial statement, are also the timing and frequency of these statements. Now, for service providers, like the small and medium businesses in this region that are providing services to the industry can require the service providers to disclose in certain way. It could be the way that they currently disclose their health and safety records and targets and metrics. They could now require them to provide another report covering sustainability related issues and climate related disclosures along this governance, strategy, risk, and management and metrics and targets. Businesses that are going to banks, insurance companies, banks for loans, banks for debt, or that are trying to get investors to invest in them, of course, they will form part of the financial statement, because those banks, commercial banks, are required to report as part of their scope 3 requirement, to report on the risk and opportunities that they are financing. That is when a bank, a commercial bank, or the BDC gives a loan to a business, it is not giving, it doesn't own money. The bank's money is the money of the investors, of depositors. So because it is required by investors under these reporting requirements to report on their scope 3, the only way that the banks can have that report, that information from their debtors, from those that they are financing or they are giving loans to, is to find a way to require reporting, and the frequency will be as frequency as you want loan from the banks. And they will require you either to put it in the financial statement or to make it separate, as generally, you know, the way the banks require environmental impact assessment report, right? It doesn't come in the financial statement. It's a separate report you must supply, you must give in order to give loan for starting project, isn't it? Now, in addition to those environmental impact assessment, the financial statement, they will now require borrowers to give report on sustainability related financial information. And then the guideline, the IFRS standard statement, ensures that it requires that subsequent reports are benchmarked against preceding reports in order for consumers of these reports to see progress made by the reporter, by the reporting entity, by the business or corporation. And then there has to be an explicit statement in this report stating that the reporting entity, the business, complies with the reporting requirements. So that statement of compliance, the way that an audited financial statement must come with a statement of compliance with audit procedures and audit standards. A sustainability report, every disclosure of sustainability reporting financial information must come with that explicit statement of compliance with this standard in order to be accepted by the entities who use these reports. And of course, it's up to them now to make a decision whether if there's no explicit statement for the users to make an informed decision on the basis of the report that has been submitted. Now, following the FRS 2 is also following the FRS S1. I tell you, there are a number of acronyms. FRS S1, which is the general requirement, is also the FRS S2, which focuses on climate-related disclosures, climate-related financial disclosures. It requires, the objective is to require entity, that is, those required to report, to disclose information about the entities, the business, the organization's climate-related risk and opportunities that is useful to primary users, again, of general purpose financial reports in making decisions relating to providing resources, whether it's financial resources or other resources. Whether to decide whether to do business with the organization or not to do business with the organization. Whether it's social capital or community license to operate or any resource that the business will take. And as I mentioned, the scope of this climate-related financial disclosure is one, physical risk and transition risk. And I explained what these two mean. And also opportunities available to the entity. So first, you report on the risk that are detrimental, that will impact, that are material to the financial performance of the business, and you also report on the opportunities available to the reporting entity, business, that it can exploit to make more money, to improve performance, to as a new business opportunity or new opportunity for growth and creating value. Again, the same thing, similar to the FRS S1. The core content are around governance, strategy, risk management, metrics, and targets. And performance in relation to the climate risk and opportunity, including progress towards any related targets it has set or that has been set by any required law or regulation. And it involves scope 1, scope 2, and scope 3 greenhouse gas emissions, as we saw. So what is really the implication for the construction industry? Of course, as we mentioned, the oil and gas industry is required to disclose the categories included within its measure of scope 3 greenhouse gas emissions. This is where it comes down on service providers and value, all those businesses along the value chain of the industry and the supply chain of the industry. Because industry is required to assess significant event or a significant change in the circumstances in its value chain. For instance, a critical supplier of Suncor can be caught up in regulation that might prevent it or will make it difficult for it to continue to operate in the way that it operates. Take, for instance, land wastewater management or water management. Suncor uses quite a bit of water provided by service providers or directly. What if there is a regulation to outlaw the use of water from certain communities or from certain rivers? How will it affect the service provider that is dependent on that water in order to prove that body of water or that resource in order to provide service to Suncor? And if that service provider ceases to operate, how will it affect Suncor's operations, performance, financial performance? If the biggest contractor in terms of site preparation, turnaround construction, that is civil construction of at the site, comes under regulation that prohibits the use of certain concrete or the use of certain aggregates from certain regions or from certain mines, aggregate mines, or the concrete, the cement or the concrete it uses, it's coming from a factory that is now outlawed because of the emission level of that factory. One, how will it affect this service provider in the construction industry that depends on that concrete supplier or that depends on that aggregate mine, that aggregate reservoir? How will it affect the operation of that construction company? And how will the non-existence or the sudden out of business experience of this service provider, how will that affect Suncor's operations, whether it's next turnaround maintenance or ongoing turnaround maintenance? So this type of exposure along the scope 3 become critical to Suncor. Therefore, Suncor is required to report on that. Hence, it will require those service providers to disclose the risk they are exposed to. It also goes the same way with opportunities. Let's say there are two businesses in the construction industry. One is using traditional concrete, traditional ways of mining aggregate with a heavy equipment supplying aggregate, supplying concrete. And a new technology is coming online and a competitor business goes to apply or adapt that technology that significantly reduces mining footprint for aggregates or emission from concrete production or the supply of concrete by the business. How will Suncor, that is a client to both companies, respond to this? Because one company will enable Suncor to reduce its scope 3 emissions. Will Suncor adopt that competitor? And how will such adoption affect the business of the service provider, although provided at a lower price, but is now using, but continues to use methods and equipment and practices that are less supportive of Suncor's Scope 3 emission targets? So these are some of the questions that businesses along the supply chain should be asking as implication, and how to deal with them as they are also exposed to these risks and opportunities that will now be reported and monitored by their clients. So these are critical questions and implications. Financiers are also required to disclose how much of the emissions they finance. So a bank, a commercial bank, at the end of the day, as it reports its loan portfolio, it has to report to its investors and regulators how much of those loans are financing Scope 3 emissions. And they are required to set targets to reduce the financing that goes into Scope 3 emissions by reducing the Scope 3 emissions they finance in form of loan that they give to these businesses. Again, this is one big implication for small and medium businesses that continue to require loan, debt servicing, loans, and financing in order to grow, in order to operate, whether as working capital or as growth capital. Because the banks are required to set targets to reduce the emissions, in quote, they finance. Those targets, by and large, will be applied along their Scope 1 and Scope 2 and Scope 3 finances. And the Scope 3 financing of emission will come to mean targets on how much money they can provide in order to certain organizations, to certain businesses, to certain operations, in order to meet their own emission finance targets. So this is another implication. Asset managers are also required to report on their overall investment portfolio and proportion of their portfolio that is financing, that is invested in emissions. So they are required to have targets. Now, how that will come down to small and medium businesses is when you look for investors, big investors, whether they are private equity investors, venture capital investors, or pension funds, whatever investors you're looking for that are getting money or that must report their emission, their Scope 1, Scope 2, Scope 3 emissions. We have to be aware. Businesses should be aware that they will be looking at their overall investment portfolio and the proportion of it that is invested in emissions or emission-producing businesses, the risk those businesses are exposed to, in order to come within certain targets and progressively to reduce, to tighten those targets. So in the selection of investment opportunities to meet those targets, businesses might be left behind, or businesses might be attractive to these investors or left behind by these investors. Insurance companies too are required going forward to assess their insured portfolio and to assess the proportion of their insured portfolio insuring emissions, and to have targets to decrease those emissions over time. So insurance for starting businesses will go up, while insurance for other businesses will come down, depending on whether those businesses are helping the insurance companies to reduce their emissions insured or achieve their targets. So these are the key implications for the construction industry, that it requires heavy capital either from investors, from banks, asset managers, or real big insurance sometimes to cover their operations. So again, looking at the scope 1, 2, 3, we've looked at it. Service providers are squared up in scope 3. And these are the emissions that have to be measured, considered covered in the greenhouse gas scope of emissions. Now the question of how do we measure and track, the measurement and tracking framework. Businesses, in order to comply with regulations, in order to take advantage of opportunities that are taken at businesses that are trying to take advantage of opportunities, whether to attract loans, whether to be looked at very well by clients in the industry, whether to be able to attract loans, investors, or to be able to attract favorable insurance premiums, I expected to use certain measurement and tracking framework that are comparable, that are universal, that are standardized under the greenhouse gas protocol, under the IFRS S1 and S2, which greatly integrated the greenhouse gas protocols, the SASB, into the ISSB and the TCFD. Now, the measurement approach, inputs and assumptions that result in a faithful representation of this measurement. This is the critical requirement, that businesses use measurement approach, inputs and assumptions that will faithfully mean completely with relevance, accuracy, and material. So, and consistency. All these that we looked at, the features of the greenhouse gas program and the SASB protocol that we looked at together, they make up what we call the faithful representation. An entity's measurement. So the measurement of scope 3 greenhouse gas emission will rely on a range of inputs. And these inputs generally come from data. But the standards require that every reporting entity prioritize these inputs and assumptions using certain identifying characteristics. So one, the data based on direct measurement. This is critical. So what does this mean? What does direct measurement mean? It refers to direct monitoring of greenhouse gas emissions in order to provide accurate evidence of the emissions and the measured values. For instance, a construction company using bulldozers, all these construction equipment and vehicles they use to travel up and down or use in the provision of the service, they have emissions, carbon dioxide emissions. So direct measurement will mean that acquiring the technology to directly measure the emissions. This is given priority, but where having direct measurement of emissions, whether of the equipment, of the operation, or of the indirect equipment like traveling and all that, is very difficult, or is costly. Another database on direct measure is estimation. We can estimate and approximate the calculation of the data based on certain assumptions and appropriate inputs. For instance, if a business travels back and forth Suncoast site and Fort Mac City, where the workers live, but they have to travel back and forth the site. We know the distance traveled. We can measure the gas used to make that journey, daily, monthly, yearly. We can also measure the distance travel, which the most service providers already measure in their travel. And then we know whether the vehicle or the equipment uses diesel or gas or any other combustible to operate. So if it's diesel, we know the carbon dioxide per ton of diesel. We know the distance traveled and the amount of gas used up during these trips. So we can estimate from this data what the emission is for a given vehicle, for all the equipment used by the organization in time and over time. And then we can say in the report who is in charge, who is responsible for this, how we identify the data, measure the data, and manage the risk, how we prioritize the risk. So this is an estimate of how we can, for instance, measure the greenhouse gas emission by equipment for a construction industry. We know the number of hours worked. For a given equipment, we can measure the gas burnt during that time, or the diesel burnt, or any fuel that is burnt to operate that machine. We can know the electricity, the power consumed for that equipment, for a mine that mines where we mine aggregate the equipment used. We can know all that. We can estimate the carbon dioxide and other gases emitted, and we can report that within the framework, metrics, and targets. So there are emission conversion factors that we use that are sometimes regulated. For instance, the Alberta emission regulation under the tier regulation system, periodically they publish conversion factors for certain industries, for certain fuel, for certain equipment that we use to quantify emissions on the basis of the specific operations and business experience of each business. And so these can now be embedded in the report and submitted to our clients or to the banks or to other regulators, or for our own internal, for the business's internal use, for the purpose of managing the risk and opportunities. The second part of it is to use data from specific activities within the entity's value chain. So Suncor can say from Suncor and try to estimate, or it will come to the value chain and ask the service providers for specific data. in order to estimate its own emissions. What is timely and what is faithful representation depends on jurisdiction, depends on technology used, and depends on the specific value chain activity when it comes to the industry. And in Alberta, like I mentioned, there are regulations specifying what it means for the big emitters. And because the big emitters are now in the IFRS standard, their IFRS standard allows them to use these jurisdiction-specific measures, methodologies, and technologies and techniques to report in order to satisfy the jurisdictional requirement as a minimum. So the jurisdictional requirements are to serve as minimum. If they are lower, for instance, than the global investor community or requirement. For instance, if BDC, which is federal institution, requires a tighter reporting standard in order to give loans to these businesses, and Alberta has its own regulations that are jurisdiction specific. If these jurisdiction specific requirements, technology, and emission measures standards are higher than the federal government standards, then we are fine. Then the business is fine. But if they are lower, you can expect that BDC will require, the banks will require, the insurance will require the federal ones in order to be able to compare them with other businesses reporting across the country. So this is where the jurisdictional issues come into play. Then another key element in measuring and tracking under the FRIS S1 and S2 is that the data that will be used, that is used to compute, to calculate, and to report these results must be verified in order to use the statement that the report, the measurements have complied, or the entire report, the way that it was generated, complies with the requirement of the standards. These data must be verified in order to use that explicit compliance statement. In the same way that this is similar to for financial statements to be accepted by, say, banks or the CRA or some investors, they will require that the process of generating those financial statements has complied with the International Financial Reporting Standard or the local GAAP, that's generally accepted accounting principles. But this verification is to be done by an auditor. That's why we use auditors to audit the financial statements in order to verify that the data, the process of arriving at the results of the financial statement complied with the generally accepted accounting principles of audit. This is similar. This is going to be the same way, a similar way that for entities reporting under the sustainability related financial disclosure or the climate related financial information disclosure standards S1 and S2 respectively, for entities reporting to say they have complied with the required standards, the data and the process must be verified. So this brings us to two issues for businesses. One, generating the report, and two, verifying that the report in the way that it was generated complied with the process and standards required by the reporting standards. So businesses then will have to acquire the capacity or buy or engage the capacity in the same way that we currently businesses engage accountants to provide financial statement, to make financial statement. Businesses will either have accountants in-house or engage accountants outside. This is similar to how under this requirement of S1 and S2 reporting, they will either have the capacity inside required to be able to generate those reports. That's measure, track, and report those emissions within the framework of governance. That's risk and opportunity framework of governance, strategy, risk management, and metrics and targets. Report them in the way that the users will accept, and then it has to use external verifiers to verify that this report has complied with the reporting standard. Then those reports become universally acceptable, comparable, and usable by all the users, whether investors or clients or banks, resource providers and regulators. So this is where we end the presentation, and we are open for questions and discussions. Thank you so much for this session. I hope it was informative.
Absolutely, Joshua. I think this was very eye-opening. I think you did a very good job to highlight the importance of GAG reporting, especially on Scope 3 for organizations of our nature. My question is about the need for verifying information that we will gather. I can appreciate the fact that internal accountants would have to find a way to measure, report, track information in a way that is acceptable by the users of that financial information. But to have the information verified, say, by external stakeholders, or in this case, auditors, I look at the cost benefit of doing that, and looking at small to medium enterprises. Is it something that is practical, or what? What's your take on that?
My take on it, that's a great question. My take on it is, again, it depends on what the business is doing. Is it managing the risk or the opportunity? That is one question. So on the opportunity side, if a business, for instance, says, wow, they have invented or they have come up with a process that reduces emission by 50% for the construction industry, for instance, right? For you to buy that report, you want to be able to have that verified by external parties, don't you?
Absolutely.
Now, but for the business, there's incentive, because if it is approved, if it is audited and approved by external auditors, then it's a stamp of approval that, hey, we have been audited by external people and we can say that our machines invented or our process reduces emission. This is on the opportunity side.
Absolutely.
On the risk side of it, now, if you go to a bank and you want to say borrow, say $150,000 to deal with working capital, and the bank is telling you we need audited finances because it's embedded right inside of it, or we need audited finances, or we want a separate report on your risk and your climate-related risk and opportunities. Now, think about it like environmental impact assessment, right? That is a risk. For a business, say you want to build a gas station or you want to buy a gas station. If you're going to use your money to buy it, You don't need environmental impact assessment, do you? Because it costs money.
Right.
But if you want a bank to finance it, especially if you want BDC to finance it, they will
Yeah.
give us an environmental impact assessment.
That's right.
By the way, that environmental impact assessment must be produced by what? A professional, right?
Exactly.
Outside person.
Yeah.
So then you, the business, will assess how much am I going to pay for that? How much am I trying to get from the BDC or from any bank for this? Is it worth it? If it's worth it, you pay. If
Right.
it's not, you walk away, right? And this is how it goes for any external verification. For instance, there is no law on financial statement that says that financial statement must be audited. In fact, if you're a private organization, unless your shareholders require you to provide financial statement, you're not required, are you?
No, unless if you're a public corporation, of course.
Exactly. But if you're a private corporation, now you have a need to produce financial statement and it must be audited by external auditors, right? But if you're a private corporation, you don't need any external interference and your shareholders are happy with it, no problem. That is how this also is. If you just want internal business risk management perspective to climate-related risk and sustainability-related risk, then you set up your risk management process the way we have risk management division or risk management organization within organizations today for financial risk. It's embedded in that because IFRS wants integration between the financial risk management and the climate-related risk management. Right. They want it integrated. Now, if the business is achieving its target, is happy with how this risk is managed and how the report is used internally, then having external auditors is extra money, is not necessary, is not needed.
Yeah.
Right? But if you want to do business, say with Sonko, and Sonko says, I like someone else to see this report you're providing. They look so good. I want them to be verified. Maybe because I want it to serve as best practice.
Yeah.
Right? Other service providers that we have.
Yeah.
But we need you external verifiers to verify before you register with us, before you bid for this contract, before we let you in, or before you continue to work with us, because we consider your operation as high risk to us. Then you have to decide first to generate the report, and then whether it's worth the while to have Sonko accept your report. If you are other businesses that it costs so much, you don't want to deal with it because the contract you are getting from Sonko is not worth it, then you move on. But if you need it, the way that we are required to submit HSC management plan, or is it this core, is it core compliance things and all that? If you want to do business, then with them, and if the business is worthy, you find out that by and large, the cost of doing it, you will always internalize it because it makes your business make more money by doing it than not doing it. This brings us to the point of the business decision. Is it financially relevant? Does it help your bottom line to do that? If it does, you do it. If it doesn't, you walk away.
Absolutely. Yeah, that makes sense. If you're doing a financial audit, it's a whole different dimension or different discussion because of the cost involved. But if you are going to audit simply a certain aspect of the GHG reporting, then you're dealing with certain subject matter experts, and that can be financially affordable, I think. And yeah, so it's quite interesting. It's quite interesting.
Definitely. Definitely. Yeah. One of the things really we do is to make sure that we're embedded in building the internal capacity for businesses so that it's like having an accountant work closely with a business or being internal to a business. If the accountant is good, then you know that the financial reports as they're coming up, they already comply with bigger regulations outside. So the auditing process becomes easy, and it's just
Absolutely.
a stamp of approval. But if businesses don't engage those capacities and being focused on what they do best, they are not focused on these things. Then bringing external people to audit becomes quickly a nightmare scenario because everybody's running around last minute. You know what I mean? Yeah.
Yeah, absolutely.
Mhm.
Very well answered, Joshua. Appreciate.
Thank you so much. Thank you so much.